Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Really excited for today's show. We've got Tom St. John on with us today. So, Tom, welcome.
Thanks a lot for having me. It's a pleasure to be here.
Yeah, absolutely. So, do us a favor and tell us a little bit about yourself and how you got into kind of real estate in general and then multifamily.
Well, I grew up and still live in the Toledo, Ohio area in the
Mhm.
Midwest. Kind of a manufacturing, definitely a blue collar town. I didn't
Yep.
know anyone who owned businesses, let alone anyone who was wealthy. I kind of grew up doing what everyone told you to do,
Yep.
watched my dad work in factories, shift work, nights, weekends, holidays. I guess my story started when in around 2005, my dad had a heart attack on a golf course in early 50s. I'm kind of forced to retire. He kind of told my mom, whatever we got, we got. And a couple weeks after that, a big package came in the mail, and it was a telescope. I
Mhm.
talk about this story a lot, but that telescope just resonates in my memory. And to me, it just represented like what 32 years
Mhm.
actually gets you. So I kind of watched my dad, 32 years of factory work. And I kind of, at that point, I was just determined to find another way, right? All I had the money to do was go to the library and start reading books. And I couldn't even afford to check them out. I just sat in the library and just read entrepreneur this, business that. And ultimately, all the books I've read, one of the common themes in them was just real estate. It really spoke to me, and I kind of dove head in, and I've been addicted to it ever since.
Yeah, yeah, awesome, awesome. How did you get your start in real estate? I mean, walk us through your first investment and kind of why you chose what you chose and how you did what you did.
Well, around that time, I started looking for people who were doing what I wanted to do. And I found a guy, I asked him if I could have a job, working
Mhm.
for him. He couldn't afford to pay me anything. And my negotiating skills back then were awesome. So I told him I'd work for free. I thought
Mhm.
you can't say no to that. So I found a guy who had about 12 single family houses, but to me, that might as well have been 1,200.
Yeah.
And so I just kind of worked for him. I cleaned out his vacant properties, and he ended up selling one. Just wanted to free up some capital. And I just went to the bank, kind of figured out what I needed to do. I saved as much as I could. It wasn't until about almost 2007, really late
Mhm.
2006, where I finally bought my first house. And my plan was always multifamily. That was always my
Mhm.
goal. I just didn't think it was possible then. It just wasn't in the cards for me to walk into a bank and ask a loan on even an 8 unit, let alone an 80 unit. So I started like a lot of people start, just kind of one house at a time, scratching and clawing to build up any kind of portfolio and any kind of track record of successful management. That way, when I walked into a bank, to me, it was a requirement then. Maybe it wasn't, but I wanted
Yeah.
to validate myself and show them that I have some experience.
It definitely helps. Now, I think in 2006 is when you said you got your first one. Just walking to a bank would have got you a loan. But yeah, I bought my first investment property, a single family home in 2007. Told the loan officer that I was going to buy it and rent it out. I got a 100% financing loan.
Yeah, those days are gone, of course. Even today, it still has an impact on how
Mhm.
real estate operators operate because of what happened in '08. And a lot of bad came out of it, but a lot of good. For me, 2008, 2009, the property values where I live dropped 30, 40, 50%. I kind of like didn't really care at the time because
Mhm.
I knew property value eventually would come up. But my problem was, we talk about how easy it was to finance, but after that, it wasn't about finding deals. It was the credit crunch. I couldn't walk into a bank and get a loan for anything. It just shut down for guys like me. So I had to do all kinds of stuff that I wouldn't teach, but I wouldn't recommend, but I did a lot of creative financing strategies to
Mhm.
acquire property. Probably had from 2007, 8, 9, I probably bought maybe 4 houses a
Mhm.
year,
Okay.
all kinds of different ways. The values were way down, as I'm sure you recall, but I never had to lower the rents. So I was still able to cash for a little bit and kind of stay above water
Yeah.
and just ride it out. Real estate, it can be a very forgiving business. Time will heal a lot of problems, and
It does.
if you're able to hold property.
Yeah, that's the key. If you're able to hold, time's going to heal everything. So you started single family, did some creative stuff. You said your goal was to always get into multifamily. When did you start really kind of turning your sights on multifamily and I guess start realizing that you could actually achieve that?
That wasn't until 2015,
Hmm.
actually. I always tell people it took me 9 years to get started.
Hmm.
I would tell people starting off now, you don't have to wait 9 years to buy a multifamily. I just didn't know any better at the time. Everything was my own capital, my own money. I look at a $500,000 apartment building, you need a $125,000 down payment. There's no way to get that if you don't
Yeah.
have it. That's
Right.
the barrier to entry. In 2015, a different friend of mine had just a little 12 unit that he was looking to sell to buy a 64 unit, which he
Hmm.
still owns today. And so I just told him I'll buy it. I have no idea how I was going to do it. And I had about 50 houses at the time And what I had to do, it was a tumultuous time, but
Mhm.
I ended up having a auction. I had an auction. I sold like 10 properties, like for minimum bids. It was crazy. I lost big on some of those houses, but
Mhm.
I had enough principal pay down at the
Mhm.
time and had built up enough equity to I was able to acquire enough for my down payment. And that was just the direction I wanted to go. So it was worth it
Mhm.
to me. And
Awesome.
within the 2 years of doing that, I had three or four small multifamily apartments and I was in the game, right? I
Awesome.
felt good about that.
Yeah. Now that transition from single family to multifamily, were there significant challenges? I mean, you already talked about obviously the down payment and the barrier to entry, but were there other challenges between single family and multifamily that maybe you didn't expect?
I've always been like a in the trenches. I've been the operator, the guy finding the deals. I've been the property manager, the maintenance guy, the leasing
Mhm.
agent. I was a one-man show for many, many years. And one of the management challenges was just the tenant relations being so close. That was a little bit challenging. The parking, stuff like that on a granular level as far as management. What big challenge for me was I'm always like 5 years behind technology. I'm not a tech guy. So
Yep.
like automating leases, lease renewals. At one point I had, say 40, 50 apartments. I remember a time when I didn't realize the apartment was vacant until I didn't get the rent. By the 10th, I was like, man, I got to start systemizing things, sending out lease renewals 30 days in advance.
Mhm.
I own a business here. I got to treat it like one.
That's happened to me before where, you're expecting a rent check to come in. And yeah, this is one of my single families where we had a property manager. So anyway, we had somebody who's supposed to monitor that for us, but whoops.
Yeah.
Yeah, we didn't get a rent check this month. Thanks. Yeah, definitely. So how do things progress from there?
I was kind of just floating along, looking at how to get my next property. Were really like light lifts, right? They were pretty
Mhm.
simple. The rents were way below market. I'm not the kind of guy. I don't like to go in and jack everyone's rent up to crazy amounts. I like to provide value, fix stuff up all the right way,
Yep.
provide a good living experience from I look at it from the tenant's perspective. So those were pretty easy, like little value add plays.
Hmm.
And I didn't want to sell them, but I found another opportunity and I had to kind of sell those to raise capital to get to the next.
Hmm.
That's the pattern I guess I'm leaning into is I've
You're trading up essentially what you're doing.
trading up, yeah, but I never was able to really truly scale
Hmm.
to a sizable portfolio because I always had to sell the previous one to get to
Hmm.
the next.
Yeah.
And a refinance would have worked financially to get to the down payment, but then the cash flow would have been too tight on the
Yeah.
original one. So that's what led me to considering syndications and raising capital. But either way a person goes, I think is
Mhm.
okay as long as you have that path,
Yeah.
and have a plan. Keep it small, keep it all was my mentality for a long
Hmm.
time. I had my own little portfolio in my hometown that I could lay eyes on. I think it was when I had my daughter that I thought, man, I want to get more passive, but just kind of build up some strategic partnerships and do this on a larger scale.
Yeah. All right. So you basically hit that ceiling, and
Yeah.
a lot of people do. You hit the ceiling. I assume that you jumped into the syndication world from here.
Yeah, it wasn't very smooth at first, though. I
It
don't know.
never is.
Yeah, I analyzed the deal. It all pencils, everything works out, but then like, wait a minute, you have these LPs with pref rates and the waterfall
Mhm.
structure. You're kind of serving a different master. I learned pretty quick, like a 36 unit or a 46 unit. I mean, you could syndicate it, but the
Mhm.
numbers don't work at that scale quite as well when you have equity investors that expect a return. And that was a big transition for me. And I had never even up to that point considered a agency debt. I didn't even know what that was. What agency are you talking about? Really quickly, I understood I have a lot to learn here.
What were the biggest challenges you had? I mean, you mentioned debt already, but all inclusive, going from keep it small, keep it all. I like that. Keep it small, keep it all to syndicating and bringing more people in. What were the biggest challenges there?
I think it was just finding, well, first off, raising capital is not an easy thing to do, but finding the right people. When it's all my own money and my own time invested, you might accept a little higher level of risk because you're just risking your own. I never had anything to begin with, so I never felt like I was risking that much anyway. But when you bring in a private equity, a guy that gives you a 50 or $100,000 check, man, the level of stress goes up and it's a big responsibility.
Yeah.
So finding the right people as a team, asset managers, site managers, and partners that cared as much as I did, it was really difficult. And it was also really difficult for me to let other people do their job because I felt like I always had my hands in everything. That was a big challenge to let that go. But as far as building a team, be patient doing that and find the
Yeah.
right team. It'll pay off in the end. That on top of raising capital, there's been times where it's easier than other times, but it's always difficult and it does take a lot of work.
Yeah, it does. There are some definite benefits to owning 100% of a portfolio. Your management meetings, have no arguments at all, but once you bring partners in, once you bring investors in, the complexity scales, and it scales
Yeah.
really fast. So,
The organization, the communications, the reporting, I
mhm.
mean, you got SEC compliance. There's a lot of hats you got to wear. And it's very difficult to be successful as a syndicator when if you're doing it on your own. I don't even know if it is possible.
Yeah, it is. I don't know anybody who's been successful long term at syndicating by
Yeah.
themselves, and this podcast, we hit our 6 year anniversary in a month and we've done
Nice.
500 episodes. So, when I say I haven't met anybody who's been successful at syndicating by themselves, I'm looking back at, 500 interviews with people who've been
Yeah.
doing this. So,
Yeah, that's when a window in my life opened up, just driving by a 280 unit apartment complex
Mhm.
before I even knew what syndication was. I just thought to myself, like, who owns that? How did he get the down payment to buy that? And if he had the down payment to buy that, why would he just
Yeah.
have a private island somewhere?
Mhm.
And then it kind of occurred to me, like, it isn't just one guy that owns it. It's 100 people just like me
Mhm.
that own a small percentage of it.
Yeah, for the large ones, it's definitely like that. I mean, I remember sitting out with my friends. This is, I was in college. I got married early, and so did a couple of my friends, but we were all living in the same apartment complex. Remember, we had similar conversations. We're like, man, I wonder who owns this.
Yeah.
We got to figure this out. How can we do this? And then we all went, got jobs in different locations and went our separate ways. But that was something from very early on that I was thinking about as well. Is just like, I don't want to own that single family. I want to own that large multi. And what you said early on, really resonated with me too. I couldn't figure out how to do it, so I started buying single families.
Yeah. That was the only path I knew existed, really.
Yeah.
And one thing that's got me as far as it has, I've always been an action taker. So I think taking action is important, but I wish I had a mentor early on. My trajectory would probably have been a lot different, but
Yeah.
it is where it is. And it's been a lot of fun. I look forward to continuing on, but having 50 single families and be able to raise enough for $100,000 for a down payment, that was the only path I knew existed at the time.
So how have things changed recently? I mean, you started syndication. Where do you own properties? What type of structures have you been looking for and such?
Yeah, mostly it's still in my hometown area. I have built some strategic partnerships with a couple guys in the Houston area
Hmm.
and just super high level guys with unbelievable integrity and unbelievable ability to perform.
Hmm.
I look forward to growing them. And it's hard for me to invest with someone where there isn't someone there locally. I just feel like you have to have someone that can
Yeah.
walk the property. It's disingenuous for me to when I raise capital when none of the GPs or the lead sponsors, no one's there. So Houston, the Phoenix area, I have some people I work with there. Indianapolis is another market I like, and it's
Yeah.
3 hours away. I could drive there. And then again, my local market.
Awesome. Something you said, absolutely crucial. If you're not boots on the ground, you have to have somebody who's there. I do have one property in my portfolio where nobody in the general partnership is there. It didn't start that way, but we had somebody move, the person who was the boots on the ground. But a lot of the little issues that we have could be easily solved by somebody swinging by once a month.
As long as there's some active management there,
Yeah.
what I've found too, and I've really enjoyed lately is, branching out and networking with all these people like yourself and other real high level groups. I started a fund of funds, which
Mhm.
again, had no idea existed six
Yeah.
years ago. And so I raised a lot of money for other real high level guys through my fund. And
Mhm.
that gives me a lot of peace of mind knowing I'm doing the right thing by the
Yeah.
investor. There's a great property in another state
Mhm.
and that's a better place for them to put their money than my little property in Toledo.
Yeah.
And so that it builds a lot of credibility and trust. You learn when you start to grow in real estate, especially in syndication, you're not investing in deals anymore. You're investing in people.
Yeah, definitely investing in people with it. That's a component that you can't separate. Somebody asked me a week ago, would you rather invest with a good operator with a mediocre deal or a good deal with a mediocre operator? And my answer was simple. You can't separate them. You got a property, you got an operator, you put those together, and that's the deal there, right? So
That one's a no-brainer. Yeah.
yeah, so they're inseparable. But the people operating it, I would say, are probably more important than the property itself. But
I learned that the hard way.
you do. You do. I have seen some people operate and run things into the ground before, and it's definitely key there. So, in general, you're raising capital, you're placing it with solid operators with a track record in markets that you believe in and you trust in. Awesome.
Around
Hmm.
2019 or 20, the market started really going up. As you recall, my daughter was real young at the time, and I got an offer on a huge percentage of my portfolio. And I was like,
Hmm.
man, I can't believe I'm going to get this much for them.
Yeah.
I made a huge exit, had a huge chunk of money, and
Hmm.
I wanted to go towards the passive side. And I
Yeah.
made a pretty substantial investment as a passive investor. Did my due diligence. I ran the underwriting. I scrutinized every comp. I ended up losing $100,000 on that deal, or a little bit
Yeah.
over six figures because of the operator. I didn't thoroughly examine everything about his life.
Yeah.
He had other businesses. He had restaurants, a bunch of stuff
Hmm.
I didn't know about that were struggling. I don't think it was really malicious, but he
Hmm.
just was incompetent. And so then that's kind of when I founded my new company. Like, if this can happen to me, who's someone that understands real estate, it can happen to a guy that's just looking to invest passively and get out of the
Yeah.
public market. I really found my lane as just a guy who vets operators.
Hmm.
I can take the legwork and all the guesswork out of where a passive investor should put his money. I don't charge anything for it.
Yeah, awesome. Awesome. I think that's a service a lot of passive investors like because you are kind of the in-between guy. You're able to vet the sponsor. I raise money for my own deals, and of course, I'm going to tell everybody I'm the best there is, right? But that's one thing that a lot of people are accepting risk on is that sponsor, the person who's in charge of the deal. That's one of the biggest places where you're accepting risk.
It is, yeah. I am living proof of that. I'll walk you through it if you ever want to. But I mean, it's
Yeah.
yeah, the fancy pitch decks or the projections. And I love doing what I do. I love underwriting
Mhm.
deals. I love driving out to the properties, flying out to meet the sponsors, sit in their office, meet their kids, have lunch with them. That's what I really, really enjoy. People ask me all the time, like, "Well, I can't believe you do that, man." And I don't feel like doing that. It's like, well, maybe it's abnormal, but I actually enjoy it. I love everything about it. I eat, sleep, and breathe this stuff. So
Yeah, I've done a couple of different things. I think everybody, there's lots of different roles to play in multifamily. People end up gravitating towards the one that works best for them. And I did start a fund and I did start picking operators and whatnot. And there was a deal that I picked that lost a lot of money. I've split that deal up 100 different directions. Was it the operator or the market? My conclusion on that particular deal is because the market went bad so fast, they probably would have lost money anyway. A good operator would have lost money anyway. But in this case, I think they kind of accelerated the loss.
yeah,
Yeah. Hard to make money. And by the way, when you look at the timeline, this property closed in April 2022. I mean, the first rate hike had just happened and then things went downhill fast. Go ahead.
yeah, they're both important, of course. A good operator will stress test a deal to the point to where they're projecting to sell at a six cap. Well, see what happens if it's a seven cap,
Hmm.
or you have a 5.5% interest rate. See how that deal works out at 7.5% interest rate. That's pretty extreme, but I'll stress test a deal until it fails.
Hmm.
That way I know exactly what has to happen for this deal to go bad.
Yeah.
Now, that 2022 time, like you talked about, you can plan for a lot of things, but that one was pretty extreme.
Yeah, it was. It was. We were kind of talking about the money issue. One thing syndications do is we get money on the front, money on the back end, and there's not a whole lot in between. So you mentioned you're working on trying to build up that other cash flow as well. How's that working out for you, and why? I think this is probably the most important thing we people coming into the syndication world need to understand.
Yeah. The way I like to explain it to people is,
Mhm.
real estate's my passion, right? I
Yep.
just love it. I think it's the tax advantages, the tax deferred growth. But the way I like to describe it to people is real estate, to me, it's always the vault, but it's not always the ATM machine. So the cash flow from operations and stuff, it may not cover all your monthly bills or create
Mhm.
this lifestyle that you envision from owning a 100-unit apartment deal. So what I've done is I've started investing a lot of my personal money into private credit and real estate debt funds. And I found that my investors really like that too, mainly
Mhm.
because it's not a 5 or 7 year lockup. The two funds that I invest personally in are 12-month lockups. You get 12% interest. Who's going to argue with that? And you have the option to reinvest the distributions, which accelerates compounding.
Yeah.
People, when you talk to an investor about compounding, they always say, yeah, it's earning returns on your returns, which, yeah, that's true, but only when it's uninterrupted. When you invest in the public markets and you have the swings, a 0% year, a 4% year, then you have an 18% year. Well, you say, well, I average the same as you. It's like, well, why do I have more money? my average return was uninterrupted. Lately, I almost have had a little bit of a pivot and a shift towards vetting operators of these private credit funds. The one provides loans for small businesses, and it fills a huge, same thing with real estate debt.
Mhm.
It fills a huge gap in traditional financing that was created by the 2008 debacle. These very highly qualified borrowers can't walk into a bank.
So they don't have W-2.
Yeah, they don't have a W-2, or they don't check out whatever boxes the
Mhm.
SBA wants them to check, you know.
Yeah.
So I've found a lot of enjoyment out of that, a different new avenue of not just real estate, but just the whole world of private alternative investments
Yeah.
that's where I belong, and it's what I'm super passionate about.
Yeah, a lot of good stuff there. But I think point for people listening, when you get into the syndication world, you're going to get checks when you buy, checks when you sell, and
Yeah,
you got to figure out how to make that in between work.
you have those buckets, right?
Yeah.
You got that growth that real estate can provide, the tax benefits. But once you get to a point, you have to start thinking about, some other buckets
Yeah.
as far as monthly income. I think.
Yeah. Going into this last downturn, I was very hyper allocated to real estate and, took a significant hit. Going forward, I'm going to structure a lot of things differently. I'm going to build definitely cash flow, and it's not necessarily going to be multifamily, but I think we both agree, multifamily is a great way to build wealth, but it's not always the best way for cash flow.
I think, yeah, I would agree with that 100%. I think it's the best way to build wealth. That's why I kind of came up, maybe I didn't come up with it or I read it somewhere. I think real estate's the vault, but it doesn't
Yeah.
always have to be the ATM machine. That's how
Yeah. I love
that
that.
helps me, that process in my head better.
Yeah, I have a coaching program too, and there's something my partner and I always say to each other, the multifamily side is long-term wealth. The coaching is the money now. You have to figure out how to bridge the gap between acquisition fees and dispositions and whatnot. But made it work so far, It also helps that I spent 20 years in the military. I have a pension. My wife's a school teacher. So, but yeah, anyway, it's you got to
Yeah.
figure out how to fill in the gap between all that. Anyway, closing up, couple of questions for you to finish up. Question number one, what's next for you?
Well, I think what's next for me is really diving into this world of marketing. We talked about it a little bit
Mhm.
before we started recording, but that's a world that I have no idea. I was never on social media. I've never looked at my real estate business as that where I needed to be a marketer. But
Mhm.
what I feel that I offer to investors is priceless, and I feel compelled to share it. I vet these sponsors, I vet these operations. I've invested personally in the deals. The last guy who invested with me said, "Man, the reason I invest with you is because I know if I go down, you're going down with me." I told him, I just laughed. I thought that was great. So I want to share with people like what I do, and I basically tell people invest where I invest. I mean, you
Yeah.
don't have to, but my service is free. You give me a call, you get in touch with me. I'll tell you what I'm doing, what I'm seeing. I don't have a sales pitch because I don't have anything to sell. I don't,
Mhm.
and I just love meeting people like you and all these other people that I've just built some great relationships with that I didn't do the first 15 years of my career. So that's
Yeah.
kind of what's next for me is just putting myself out there and letting people know my journey.
Yeah. Awesome. Awesome. If you had to give advice to somebody who's just starting out, what would that advice be?
To find a mentor, probably even sooner than I did. The first mentor I had was a guy who owned a handful of properties. I learned a lot of what maybe not to do with him.
Mhm.
But then I kind of went on my own. My brother helped me for a little bit as a maintenance guy, but it wasn't until like 2015 where I had, 30 of some apartments, and I was like, man, it was when I didn't even realize that I had a vacancy,
Mhm.
and so I kind of just reached out in the world. And a lot of guys that have a ton of success, man, they love to share their stories. They love
Yeah.
to help younger people out. And so I would tell someone who's just starting off, read as many books as you can
Mhm.
and find people that are where you want to be. And
Yeah.
most of them will be more than happy to reach out to you. I didn't find my true mentor maybe I bet it was about 7 years in. And
Mhm.
I wish I would have found him
Yeah.
sooner.
I followed a similar path, and I love that advice. I mean, it was me to a T. I started out by reading books and then had the realization that I needed to find, a mentor to help me. And in my case, it was listen to a podcast episode. The guy running the podcast had a mentorship program. Only one I had ever heard of. I didn't realize there was dozens or hundreds of them out there and signed up the next day. And it worked, I mean, it worked really, really well. I think we were recording when I mentioned this, but yeah, we're 530 episodes in.
Wow.
Honestly, I think most people sitting where we're at right now took that same path.
Yeah, when I joined some mentorship groups or just networking with like-minded people, it was kind of uncomfortable at first,
Hmm.
because I was in a lot of rooms that I probably, to be honest with you, I didn't belong in. These
Yeah.
guys were very high-level guys, and I had maybe a little 12-unit property or
Hmm.
something. But now I take that same approach. I get in rooms with guys who operate these nine-figure funds, $100 million funds, and I have no business being in the room with them.
Hmm.
But do that if you start out,
Oh yeah.
get uncomfortable.
I've had some of my biggest light bulb moments in rooms like that, you know. One of them I've shared many times, just give you a Cliff Notes version, but I was invited to a dinner that I didn't belong at. And
Yeah,
what I noticed is they were all talking about their real estate portfolios and everything else, and they were all wildly successful. Some of which you would know. I realized walking out of them that each one of those guys had a very narrow focus. You
yeah,
know,
that's a great point.
very narrow focus. I only buy XYZ in ABC, you know, and that was it. And I was spread all over the place. I had B class, C class. I had 20 units, 40 units, 80 units, 150 unit apartments, you
Yep.
know, and that was just one of those epiphanies that, you know,
That's a great point. I've always moved forward in my journey in my life, but I've done a lot of zigzagging. To
yeah.
your point, find a
Mhm.
straighter path. I think of
Yeah, I like that. That sounds like my journey as well. You know, I've been going the same direction for 20 years, but you know, it's been a zigzag. But
yeah.
anyway, all right. Last question for you. How can listeners learn more about you?
I'm probably most active on LinkedIn. You can find me on Facebook. Just search Thomas St. John on LinkedIn. I love to connect. I got a lot of free guides and free resources I love to hand out. My
Hmm.
company is North Corp Capital. So you can go to
Okay.
northcorpcapital.com. It's my phone number on there, my email.
Okay.
Feel free to reach out. I respond to everyone.
Yeah. Just pointing out, you know, his advice was reach out to somebody, and he said, feel free to reach out. So I actually did that once after a like when I was brand new after a podcast. And 2 weeks later, I was sitting at lunch with the guy, you know, talking about, you know, rooms I didn't deserve to be in, but never hurts. But anyway, Tom, thanks for coming on the show. Very much appreciate your time today.
Yeah, it was a pleasure. I can't thank you enough. Look forward to following along with your journey.
Awesome.